Thanks everyone for attending today's kickoff week for the Junior Mining Toolkit. We're really excited to be partnering with Integra on this initiative, this 3-week series that's going to dive into some tools that we believe are going to be really helpful for young professionals and mining executives to set themselves up and their companies up for success. So for those of you who don't already know me from all the previous webinars, my name is Mal Kadwowska, and I'm an executive on the YMP Vancouver team, as well as the Vice President of Corporate Development for First Mining Gold. So just going to kickstart the hour off by really saying a huge thank you to Integra and their team for being the driving force behind this toolkit series. We're really fortunate to also have them as a regular sponsor and supporter of YMP Vancouver. I'd also like to thank our remaining sponsors. We wouldn't be able to put on these events without their support: KPMG, Cassels, New Placer Dome, Equinox Gold, Verify, and Solaris, and also our global sponsor, Rio Tinto. Also, a quick thank you to the remainder of the YMP exec team in Vancouver. They work very hard to put these events together. Mike Wooler from KPMG and Jen Poirier from Cassels, who's also a panelist today. And, specifically to this event, I want to say a really big thank you to our speakers for taking the time to come on board today. George Salamis from Integra, Jen Poirier from Cassels, and Kevin Carter from Cormark in Toronto. And really importantly as well, Josh from Integra, who has been integral in driving this event forward and who will be moderating the Q&A today. So thanks, Josh. It's been really fun working with you on this event. And, as we launch into this event, as per our prior events, note that this webinar is provided for information purposes only. It will be recorded, and while we intend to only have our presenters on video, everyone has acknowledged by registering that, due to unforeseen circumstances, there might be a situation where your image or voice is captured. And so lastly, structure of today's event. It's a little bit different than our prior events. So there'll be in short presentations along with Q&A for each segment, along with a Q&A period at the end. We are allotted an hour, although if people are submitting questions or are interested, then we will look to push that a little bit past the hour. So we encourage everybody to be asking questions. So you can use that, you can do so using the Q&A function at the bottom of your screen. And also, if you want to engage in any kind of discussion, there is the chat that is available as well. So, lastly, I'm not an IT expert by any means. If you experience any technical issues, we recommend that you simply exit and re-enter the webinar. So with that, I'm not going to keep you guys waiting any longer, and I'm going to pass it off to Josh from Integra to kick things off. So there we go.
Great, thanks so much, Mal, and thanks again to YMP Vancouver for allowing us to briefly take over their channel and do this toolkit. So for the sake of time, I know George has got plenty to say and he's chomping at the bit to get going. So let me introduce George Salamis. He's the current president and CEO of Integra Resources. I've, as I mentioned last week, been lucky enough to work with him for about the last 7 years and learn a lot about a gentleman who's had a long career in the industry and has seen a lot of M&A. In fact, over his 35-year career, he has been through 6 M&A transactions, which is quite a few. And so he has a lot of experience in navigating both the takeover and the project itself from kind of the start to that acquisition. So without further ado, George, feel free to share your screen and take over.
Awesome. Thanks, Josh. I'll just get this going here for a second. Bear with me. And here we go. All right. Thanks, Josh. Thanks for the kind introduction. Super topical today to be talking about this, setting up your company successfully, the art of junior mining, based on a white paper that we've dusted off. I did it about 18 months ago, but super topical now because basically what we have here is a situation where the market's really ripping, kind of a perfect storm of new talent entering the business. And basically what we're trying to do is arm people, this new talent of execs and soon to be execs, with the tools to kind of get them going and to set up their company properly. That's really key. And so, here's what I wish I knew 30 years ago. And so why do I do this and why am I doing it? It's really to help out the new CEO talent coming into the industry, really to avoid the pitfalls and mistakes that I've made, and maybe in using some of the successes as well. And really the idea for coming up with this, and I get asked this question a lot, is where did this white paper come from in the end of the day? And really came from attending the BMO, Bank of Montreal Mining Conference 2 years ago. And I've been attending this great conference. I think it's the best mining conference, full stop, in the world. Been attending it now for about 20 years. And I was attending the conference and watching some new CEO talent, CFO talent, men and women, for the first time at this conference, and basically showing off these great projects that they had. And it kind of left me wondering, what would I have wanted or needed back in the day when I was doing the same thing? And so I decided to put this white paper together. And so what I did essentially is, right at the end of the conference was over, and had a day off on the tail end of the conference, and went straight to the pool, pulled up a lawn chair, might have organized and ordered a margarita or three, and just wrote reams of paper. This is the good, the bad, and the ugly of my experience in driving a company forward, and the pitfalls and traps, or the positive events, and basically leading to M&A. So that's basically where this came from. And in putting together this paper, I kind of modeled it off of this great work by this legend Sun Tzu, of the 5th century BC, who put together this great document. Basically, it's his musings on the art of war. How do you prepare for war? How do you wage war? And I saw a lot of similarities in what Sun Tzu was saying, ultimately, in the various chapters of his book. And I saw a lot of parallels to the mining industry. What you do to prepare for war, and wage war and win successfully, is not unlike what we do in the mining industry. So a lot of parallels there. And so his first chapter that he put together was laying plans, basically setting your army up to wage war successfully, and really a lot of parallels in what we as a mining company do to set itself up successfully for a successful track record, either to build an asset or to sell it to somebody else. Many parallels in that. And really the first piece that's really important is, and we're living this right now, really, is when the markets turn, be ready, because the turn is really sharp. When we've certainly seen that of late, the turnaround in the resource sector, and specifically the gold sector, has been really sharp, and it does happen. It's cyclical. It happened pre-pandemic, and it's happening right now. Really, sort of the fundamental principle of this point is standing still and waiting for something to happen to your company, albeit investor attention or an actual M&A transaction. Waiting and sitting still is really a losing proposition. Really, what you need to do is set up your company to maximize on these times that happen. And last but not least, at this point, always have a plan A or a plan B when you go into to battle. Plan A doesn't always work. Market forces, whatever happens on the ground, could work against you. Always have an exit plan. It's really, really critical. Never paint yourself into a corner. Always have a backup plan when things go wrong. And that kind of leads me to the second point of the white paper. A resource asset without a plausible financing and development scenario is really a no-go. For example, a $25 million market cap company aiming to build $1 billion asset is not really a winning strategy. And, there have been some unicorns in the past, $25 million market cap companies with big project builds actually getting taken over before they actually go to finance. And, Arequipa might be one good example, Francisco Gold as well, but, doesn't happen that often. So having a resource project where you actually have a lot of options on, not just sort of sitting there and waiting to be taken over, is really, really critical. And I'll give you a good example. This wasn't in the white paper, so I'm kind of sharing this. I was involved in a company years ago that had a huge nickel project in Southeast Asia. And this project had a $2 billion CapEx to get it built out. And by the time I had joined the company had been on its kind of third iteration of trying to move forward, and third kind of management group. And we really got stuck. And it was because of that $2 billion capital number that everybody kept pointing to. Now, thankfully, we were rescued by a hot nickel market at one stage that saw the company getting taken over at a premium. But had that nickel market not come around, eventually we would still be waiting to this day, and a lot of value would have been destroyed in the process. So thankfully that happened, but just don't go there, basically, is kind of the lesson there. Second point, majors are valuable strategic partners. A corporate who takes a position in your stock really doesn't stymie competitive tension in eventual M&A. It's worth it 100% of the time, I'd say. Don't let anybody tell you that, letting a corporate into your shareholder registry removes the competitive tension, because it really doesn't. In fact, four of the 6 transactions that I've been involved with on an M&A basis in the past had some form of corporate ownership on the registry. So if you have that option, go for it 100% of the time, no question about that. Next point, leverage board experience and educate an inexperienced board. Of the 6 deals that I've been part of, they've all had a common theme where there's always been at least one person who has been there, done that in terms of driving M&A. And I'll take you back again, something else that wasn't in the white paper that I did, but my very first M&A transaction that I was involved in we were blessed to have that, which is one person on the board who had M&A experience. The rest of us didn't. And it was a chairman. He became a great mentor of mine. Jan Kaber is his name. He had no mining experience whatsoever, yet he had business experience, and he had M&A drive and experience in his background. And really that experience proved critical on the board. The flip side to this is, if you've got an inexperienced board, it's really important to keep the M&A discussion topical with your board at all times, educating them on, what your value is, what the value proposition is for your company, what your value is worth relative or compared to other companies. And that really serves to avoid management level and board level surprises in the 11th hour. And your advisors, when you hire them, can really help out on that basis, but super critical. Next point, spend time on your data room, also very critical. And this is critical for your company to play or to keep and maintain an open and level playing field with all potential suitors at all times. Spend a lot of time working on your data room, super critical. It's really a chance for your company to show itself off, show its merits, show the merits of the project, show the professional manner in which your company manages itself in the industry. And I'll give you another insight, again, not on the white paper that I wrote, but I was involved in a company that got caught behind, didn't have a data room put together, a solid one, to say the least. So, when potential buyers started to show up, there was really a sort of a mad scramble and a panic to get data into the data room. And there was a lot of time lost, and we nearly lost a suitor in the end of the day. Thankfully, an M&A transaction did occur on that. Conversely, and this is super critical, and I have seen this, seen management groups play hard to get. We're not opening our data room up to anybody. We're refusing to allow open access to any party who might want to buy us. And really that doesn't work. I've never seen that work. If somebody can show me an example where that has worked, please go forward. But keeping an open and level playing field is really critical. Next point, choose your M&A advisor wisely. Really important as well. Make sure you choose an advisor who knows your asset as well, or hopefully even better than you do. Choose an advisor that you can socialize with, that you get along with. Choose an advisor that will always tell you the straight goods, won't paint a pretty picture all the time, will tell you the good, the bad, and the ugly. Make sure that advisor has time for you. Ensure that they're not full of other files and cases that they're dealing with in parallel. Make sure that they've got time to work on your story, really important. And last but not least, make sure that their interests are 100% in line with your own interests and those of your shareholders, always. And we've seen cases where that hasn't been the case. So that's super important. So moving on to the next phase of Sun Tzu's Art of War, he had a really important chapter called Waging War. Basically, what happens on the battlefield, in the trenches, when things start to heat up, or in our case, when things start to heat up on the M&A front in the sector that you're in. So super important chapter, and that leads me to the first point of this chapter with respect to mining companies. Always prepare to finance. Preparing to finance and build an operation, as crazy as it sounds, is often a real catalyst to M&A. Threatening to actually finance and build something yourself, not faking it, but really going down that path, it usually sort of drives success in M&A. Ultimately, the buyer, the entity that wants to own your asset doesn't want you to finance. They don't want you to build that asset. They want to put their stamp on your asset. And so that's just a fact of life. And in fact, again, another sort of inside track, something else that wasn't in the white paper, the Integra Gold story and the sale of Integra Gold. Few people really know how far down the road we were towards actually financing and building the operation. We were underground, we were test mining, we were hiring all the right people on site in Val-d'Or to actually execute on the development plan. Our CFO did a phenomenal job at getting some great term sheets. We were weeks away from signing these term sheets. And in the end of the day, that was the catalyst for Eldorado to step up and buy us for $600 million. So that worked out well. In the 4 of the 6 transactions that I've been involved with in the past, that was an absolute catalyst. Next point, massive egos. Yeah, there are a lot of them in this business. One of the biggest impediments in my mind to creating shareholder value. Egos destroy armies and they destroy companies. And there are often these massive egos at the helms of power, either our armies or our businesses. And what it does when a huge ego takes control, they often lose touch with their own board, their own shareholders, their stakeholders. So a huge impediment. Again, another real life experience of my own. We dealt with a senior executive on one file who had a massive ego, who refused to engage with third parties, with corporates, with bankers, just because they thought they had the luxury of time to do so, and they quite frankly loved their cushy jobs. And so the egos were, this person's ego was getting in the way of the company quite clearly. This exec was removed and was replaced with somebody who didn't have an ego, and it was amazing the value turnaround that occurred as a result of that, and a successful M&A transaction was completed in the process. So don't let egos get in the way. Avoid what I call analysis paralysis and really rely on the math. M&A transactions are really all about math and risk analysis in the end of the day. Having a board and management group that's been there before on M&A or even building an asset, super critical. It allows for this constant reality check process between board and management. Am I better off to sell this asset or should I risk building it, financing and building it ourselves? And the absence of that sort of experience at the board level and the executive level leads to what I call analysis paralysis. You basically keep going around in this endless loop of do I or don't I? And in the end of the day, it's all about math. It really is all about math. Whether to sell or not to sell an asset, it's about math. It's about risk, value, assessment, and adjustment at the end of the day. And it's just math in the end of the day. So that's an important point. As is the following point, it's not personal. Never take what is said about you or your company in the heat of the battle personally, ever. Understand you'll never make 100% of the people around you either internally or externally happy. And that's a critical point. You'll find shareholders and even your colleagues within your own company might not be happy with a pending transaction. Again, another sort of key insight to that one. I was involved in an M&A transaction, and it wasn't Integra, with a management team that wanted to desperately build the asset, although they had no experience of their own whatsoever. They viewed this project as their own personal sort of chemistry set, and lots of risk involved in handing the keys to this group to build it. And in the end of the day, that didn't happen. We tendered and sold to an M&A at a pretty big premium. I truly believe to this day that had we let this management group fulfill their plans to build this asset, it would have been a complete disaster. Would have lost a ton of value for shareholders. So, there was lots of conflict on this deal, but ultimately it got done. And you'll also hear as well a really important point. You sold too early. You didn't flesh out enough value. You should have built this asset, etc. You can't please them all in the end of the day. You really can't. And you'll hear this noise from all sides. In the end of the day, it's really the shareholders and what's best for them that's going to drive that decision in the end of the day. But just don't take anything personally in the heat of battle. Now, Sun Tzu wrote an entire chapter on this, which is maneuvering and tactics. And critical point, because as an army marches into battle, as battle is being waged, the landscape of the battle changes constantly. And you have forces working with you at some point, might be working against you at another point in the battle, or vice versa. The landscape just keeps changing. And so the same thing happens to us in the mining business, whether it's external market forces or commodity prices, whatever. So learn to maneuver tactically is I guess the message I'm trying to put out there. Really play the game. Don't burn any bridges. Don't say never, as an example. Don't close any doors. Your dance partners, the M&As, potential M&A partners that you encounter along the way, they might get up and walk away from the table at any time, and that's okay. Don't get fussed by it. If they don't come back, others will. Just go with the flow and play along with the game, and it'll serve you well. Keep the drill bit running. That's an old adage. As a counterparty, never negotiate with something that you want to buy when the drill bit's turning. But keeping the drill bit running is really a metaphor for always have something brewing in the background of your company that's going to be an incremental value driver. And it doesn't have to be a drill bit. It can be a study. It can be something else that's on the go. But it provides for additional leverage in your negotiations. And in the 6 transactions that I've been involved with, I think there were 2 that had that aspect to them to drive an M&A deal. So super important. The issue of premiums, premiums exist in the right market. That I firmly believe that. Right now, we're in an era or market condition of mergers of equals being the flavor of the day. I can tell you I've been through 3 gold cycles. I can tell you that the premium deals always come back. The day of the M&A transaction with premium value to it will come back this time. Firmly believe that. It's all part of the natural cycle. Really what drives it is these value mismatches between peoples and owners of assets and supply and demand in the end of the day. The premiums that I've been involved with, for example, in deals have been sort of between the 20 and 50% range. And last point on this, super critical to keep your expectations in line with what's going on in the market at the time. So many companies out there say, yeah, I'm trading at $2 a share, but I should be worth $10 a share on an M&A takeover. Make sure you understand the context of the market that you're in thinking that out. Last but not least, or second to last but not least, this is a great statement. This statement was imparted to me by a very smart mining analyst, one of my favorite mining analysts named Don McLean. And I was at the time encountering some external and internal issues within the company I was part of. And he said, remember this Latin proverb, illegitimi non carborundum. And if you basically run that through a spell check, through a translator, never let the bastards grind you down. They'll be everywhere. They'll be flying at you constantly as you're trying to build the company, as you're trying to sell the company, as you're trying to build the asset. Just don't listen to that noise. And if you need to put up a big banner in your office that has that proverb on it, tattoo it to your forearm, turn it into a t-shirt, whatever it takes, just keep that front and center. Don't let external forces get you down. And then I think last but not least in all this is a message to anyone who's going into the business right now. Really enjoy the experience. And that's one thing in the first couple of transactions that I took part in. Things happen so fast in these transactions. There's so much noise, positive and negative, and really little time. I didn't have the experience to sit back in the first few and really enjoy what was going on. My message is really simply put, just don't take yourself too seriously in these transactions. Don't get high in your supply when the rocket is launching off the pad. Really times like this don't come along all that often. And really when they do, soak them in and really enjoy them because these times are rare. That's all I have. Happy to answer any questions that anybody might have. Josh, back to you.
Thanks, George. Appreciate it. It's good to see that white paper done as a presentation versus just a read. We do have a few questions for you, and then we'll jump into the other side of the M&A transaction, which are the bankers and the lawyers that sort of get the minutia done and really close the deal. So I think one of the first questions is, so you've had a lot of M&A in your career. You've been through a lot. You seem to be a glutton for punishment, I guess you might say, when it comes to M&A. So what is the number one thing you've learned through your experience in all of these transactions?
I think it's maintaining optionality for as long as you can. Having several exit doors to use at your disposal, not being painted into a corner of just one, not having to do a deal ultimately, maintaining that optionality of, I can build this or I can keep advancing this at least for as long as I can. Probably the biggest one for sure.
That's interesting. And that sort of ties into the second question here, and then we'll jump to the next group. But I do have a few more questions that we'd like to ask you, George, and so if you could just stick around and we can ask all three of you at the end. But you've given a lot of points that are key to closing an M&A transaction. If you had to pick maybe the top three that you would consider deal breakers that would stop you from joining a company or stop you from joining the board of a company, what would those three be that would really just say, no, like I'm not gonna get involved with this?
That's a great question. Three, hey? So somebody at the helm who was ego driven would probably be the sort of the biggest sort of no-go for me. And with that goes sort of management flexibility. I guess the second one would be, I definitely would not join a junior mining company that had an asset that was, required a massive amount of capital to build, and no hope of ever financing and building it whatsoever, leaving that just one track. I wouldn't do that. Been there, done that, and not interested in doing it. And third, I don't think I would join a group that didn't have at least one other either executive person or board member that hadn't been there and done that before. Critical that point as well.
Perfect. And then one quick last one from Tara, who used to cover Integra. You highlighted the benefit of having a major on the shareholder registry. Can you talk about how you best manage those relationships and essentially sometimes the demands that come with having a major as part of the group?
Yeah, in the end of the day, it's not, at least my own experience, it's not that complicated. Keeping an open line of dialogue with that partner is key. Really, as well, depending on their ownership level, regarding them as any other large shareholder, keeping things fair on that basis is a balance for sure. And we've all experienced that before. And just keeping amicable relationships going at all times, never letting conflict creep in. They might disagree with what you're doing, your development plan, etc. Just smile and say yes.
That's good. That's great advice. So, stick around, George, because there is a few other questions that we have that would be great to hear you answer alongside Jen and Kevin. But with that said, let's pass the baton over. And so I'm happy to introduce Jen Poirier, who's a partner at Cassels, and Blackwell, as well as Kevin Carter, who's Managing Director of Investment Banking at Cormark. And, they're going to essentially take the other side and some of their observations of M&A in the sector and how it works. But I'm really excited because, I've obviously been around George and the corporate side a lot, but it's always interesting to hear how the legal brains and the banker brains, take what can be a lot of minutia and a lot of moving parts and close the deal. So without further ado, go for it, guys. Thank you.
Thanks. So just to reiterate, in case anybody joined late, there is a Q&A button down at the bottom of your screen. So if you have any questions throughout the presentation, just go ahead and type them in there, and Josh is going to sort of help compile those questions and bring them in at the end of the discussion. So for purposes of just giving you a sort of lay of the land, we're going to take you through sort of start to finish of the deal options that are available to junior mining companies. We're going to obviously end with the M&A aspect of it, but we're going to begin a little bit earlier, kind of go back to where the exploration and the sort of magic happens that way. So we're basically going to go through the stages of the life cycle of a mining project, starting from exploration, what kind of deal options are available there, where the company is trying to put money into the ground to see whether there's any sort of proof of concept of money being able to be taken out of the ground. So whether that's funding drilling and reconnaissance, etc. Then we'll move into the deal options that might be available at the sort of feasibility stage, where you've actually been able to prove an economic model for the project, and what things companies consider at that stage for financing, for deals. Then finally, what types of options are available at the development and construction phase. So we're going to basically discuss those deals at each stage that might be available to a junior issuer. And we're going to talk about some of the trends that we've been seeing lately at each of these stages of the deal. And then we'll give you some thoughts on the ways in which juniors can prepare themselves for landing a deal at that specific stage. So basically, as a framework for the discussion, Kevin's going to discuss give us a brief description of how the market actually reacts to these various cycles, and it'll help set the stage for the various stages that we're going to discuss.
Kevin, you're just muted at the moment.
Sorry about that. So thanks everyone for having us. It's nice to present. Hopefully there's not too much of a drop off when they hear a banker and a lawyer get on the call, but I think it's important to, my take on this is, the investment industry and legal industry, we're service providers to this group and to the mining industry. Hopefully a lot of the people on the call end up being clients at some point, but I think the perspective that gives us is that we are observers. You guys are the ones that make the party. We just watch it. And so it gives us sort of sometimes a unique perspective, and we got a lot of time to sit back and analyze what's happening and follow the equity markets and different markets around the world, and try and give that feedback to our corporate issuers. So when Jen and I were discussing how do we present this, there's a famous chart that came to mind, and I'm going to share my screen. We don't have a lot of slides to share, but I think this one's relevant. Standard disclaimer, because we do have a lawyer on the call. But so this is a curve. I'm sure a lot of the people on the call have seen this. I heard it first. It's called the Lassonde curve. There's a lot of different names that people apply to it, but what it is it's a market perception of how the markets value a resource project through its life cycle. And there's a couple of interesting takeaways. This doesn't speak to resource growth or production growth or cash flow. It's basically, it's the perception of value of that asset. And I think the first takeaway, which is kind of interesting, is there's inflection points along this curve that are basically opportunities where value is changing or is expected to change as these projects are developed. And what that means is, to us, is that there's an opportunity for a transaction to occur. If there is a difference between buyers' expectations and sellers' expectations, that creates an opportunity where maybe you can see your way to a transaction. What also I think is the two kind of key takeaways, this isn't sort of like a pharmaceutical model or a different business model in the sense that this isn't linear. It doesn't just march slowly over time where you see a stepwise progression in value. It changes over time as the project gets de-risked, and there are actual points where the perceived value of a project can actually be lower than previous times during the cycle. The other thing that I think is very key to take away is when you're thinking about the development of a project, the markets are sophisticated now, and there's effectively a subset of investors that will play different parts of this curve. Their funds are set up different ways. They've got different internal strengths or technical capability to assess projects along this curve. And so when you're thinking about developing a project and developing a company, you have to manage your shareholder register as much as you have to manage your project, because there are times where if you've met a certain milestone and certain investors have been playing your story to get exposure to that type of development, and now they're starting to cycle out of your stock, it can cause some pressure on your stock. Particularly phases like permitting, or once economics are known, if there's not a lot of catalysts that are near term and on the horizon, you can get stuck into that development curve where the market perceives that you've got a lot of capex to raise, you're waiting on a permit that may or may not come, and the market can become very short-term thinking. And we've seen that in particular in times of volatility like we have now. A lot of institutional fund managers, they're mark-to-market quarterly. They don't have the longevity and the long view that they may have had in previous cycles. So the other thing I take away on this slide is there's no time scale associated with it. Some projects can move very quickly through exploration and development. Some can achieve a construction decision very quickly and get their construction financing very quickly. Others can be stuck at any point in this curve indefinitely. So there is really there's no tested time cycle to this. And in particular for mining, what makes it challenging is our project cycles tend to be longer than some of the other resource industries like oil and gas. So that creates interesting challenges and opportunities as it relates to financing. The other thing that, in terms of just drawing a parallel against other verticals, is if you look at something like a biotech company, they have similar life cycles, and from the perspective that they spend a lot of time pre-revenue. There's a lot of R&D involved. There's a lot of capex associated with it. I think the biggest difference with our mining market and some of these other verticals around the world is our pools of capital are not quite as sophisticated. Pharmaceutical companies have things like venture capitalists or angel investors or different types of pools of capital that they can tap into. We don't have that luxury. So what ends up happening is a lot of junior resource companies, they end up going public earlier than what you see in some other verticals, and which means they basically start their public life at the left-hand side of that curve, where they're essentially predominantly dependent on the equity markets. It's effectively their only currency. So it's very important for you to manage that currency. But it also means that you're introducing volatility into the public equity markets. And so that's why you get the different types of actors, different types of investors in resource companies. Some are playing for the big drill result and the 10-bagger. Some of them are playing for stepwise de-risking. But it just creates a very unique dynamic, which introduces a lot of volatility in the sector, which is something that needs to be managed. And then the only other slide I'll put up here is all of this happens in the context of the commodity cycle. And so what that means is you have that typical Lassonde curve, but depending on where the general state of the commodity that you're trying to develop is moving, you can either have dampened or accelerated swings in that curve. So as an example, you could have one of the greatest coal intercepts known to man in the last year, but given what's happening with the green energy revolution, be very difficult to get a large amount of investors excited about something like that. Conversely, if you were to drill a very high-grade gold intercept, I think everyone knows that the gold market's in a bit of a different space now, and I think that it's met with a very different reaction from the public markets. So it's important that that context is taken into consideration, because, again, to George's point earlier, it is about planning, having a plan A and a plan B, and be very cognizant of what's happening in your underlying markets. Because if you wait for that catalyst that is within your control, and unfortunately your commodity price goes away from you, or the investor base that normally would be subscribing to something like this is not there, you can run into some really big challenges. So I'll put it back to the regular screen. So what I'll do is with that, so that's the curve. I think it's a nice sort of benchmark, and we'll come back to that a few times. But I guess at this point, I'll throw it back over to Jen. And you can just talk about, given that equity is the primary currency for these, what are some of the equity deal options available for earlier stage junior resource companies?
Yeah, so as you touched upon, at the earlier stage, there really is going to be a sort of specific type of shareholder base that you're going to be attracting. At the early exploration stage, it tends to be more retail investors versus funds, just given the fact that a lot of the fund mandates, don't permit them to actually invest in, early grassroots exploration. So typically then you're going to be looking at retail investors or money coming in from the sort of founders, promoters of the company, as well as other insiders. So with that in mind, the things to think about are, what are the sort of options to make a deal attractive from a perspective of having an investor come in. Quite often we'll see that there would be a private placement sort of structure as compared to a prospectus offering, where those tend to be a little bit more attractive at sort of the mid to senior tiers, depending on the amount of the raise, just because of a lot of different factors, such as the increased cost of running a prospectus offering versus bringing in funds sort of quickly through a private placement. But as far as the private placements go, of course, they can be brokered or non-brokered. If they're brokered, you get the benefit, obviously, of having a sort of broker agent who can use their book to sort of tap into those retail investors. You can also gain retail investments through independent research firms that can actually provide coverage of your company, which may actually help attract retail investors if you don't already have those in your pipeline. But as far as structuring, often there's something more than just a common share that's being offered in these deals, only because trying to make it attractive to investors. So quite often you'll see unit offerings where the sort of sweetener of the deal is that in addition to buying a share, you get a warrant that allows you to sort of continue your investment in the company in the future. If it turns out that, you want to buy an additional stake in the company, you can exercise that warrant at preset price and, increase your equity stake in the company, which also obviously provides a benefit to the company in the sense that increased cash available once the options are exercised. Another thing that I'm sure a lot of people have heard of, depending on if the company has projects in Canada, is a flow-through financing, where the tax benefit of making certain Canadian eligible expenditures on a Canadian property can actually be passed down and flow through to the investor, so that the investor can actually reduce its cost base. So that can actually enable a company to offer a common share or a unit at a higher price than they may normally be entitled to get at that stage of the development and at that stage of the market, just because of that tax benefit that can flow through to the investor. Another one that's kind of common is some investors don't want hold stock. So if you're familiar with private placements, there is a 4-month hold on the shares or securities that you buy that restrict trading. So one way around that some mineral exploration companies have been doing is something called a special warrant offering, where the security that you originally get is a special warrant that's offered on a private placement basis, so it's hold stock, but then the company actually subsequently files a prospectus, and with the aim of truncating that hold period so that you get free trading stock upon conversion of those special warrants. And ideally, the goal behind it is to significantly lessen the 4-month hold. So those are sort of the 3 kind of sweetener structuring options that I've seen a lot of. And as mentioned, prospectus offerings tend to be a little bit less common. other than the special warrant offering. Although you do see them still, and you can see them for, any amount of money, 5 million, 10 million. They're just less common for a sort of smaller raise for a junior issuer. But I'd like to actually ask Kevin, because he's obviously sort of really familiar with the deal pipeline and what approaches people are taking to structuring right now. So I'm just wondering if you could talk about what kind of trends you're seeing in light of the description I just gave of the financing option. And in particular, in light of COVID, have you been seeing any sort of new creative structures that weren't maybe coming out before?
Yeah, so I think so again, it's key to think about, equity is kind of junior resource companies' single most valuable tool, in some cases the only tool. So really it's a matter of protecting that equity. This isn't a verified commercial where dilution is the solution. Dilution is something that every junior mining company has to go through, but it's all about having the best equity valuation so that you can minimize that dilution, which, obviously on a per share basis, if you're drilling off ounces, having less shares outstanding means you have more ounces per share. So I'd say in terms of recent trends, I think that the overarching comment would be people take the money when the money's there. I don't know if there's been many CEOs that have said to me, "Oh, geez, Kev, last year we raised too much equity. We shouldn't have diluted that much." You don't know when these windows open and shut, and certainly in the COVID environment, we had that initial snap down of the junior gold equities, along with the rest of the market, and they returned very quickly. And now today we've had another drop down, and the gold equities have gone with it again. So, first advice is you take the money when the money's there. Typically, when the money is being offered, it means the market is buoyant, which is generally an indicator that your stock price is probably reasonably buoyant as well. The desperation financings are tough to come by, and they're really hard to get over the line. So I'd say that's definitely a recent trend. I think some of the other commodities are starting to see some life as well. So those management teams and those companies are obviously looking at their balance sheet with a keen eye on if there's a window available to them. I think you'll see them hit the market. The other thing too is just around timing, to the extent that you can manage it. Bringing it back to the Lassonde curve. You saw that dip as you go into sort of resource development, economics, and permitting and whatnot. And there's interesting strategies around, if you're a junior resource company, when do you come out with your initial resource estimate? How big is it? And what does it mean for your stock price and for the market? And I'll give an example. Integra Gold did a really good job of this, where when you come out with a resource estimate, sometimes what can happen is it can put you into a box, because the market will look at that and say, okay, there's X number of ounces or pounds or whatever there, and they start to screen you on some metrics. So it'd be EV per ounce in the ground, and you can be put in that box. The way that you can kind of dampen that downdraft in the Lassonde curve is by effectively coming out with a resource estimate, but backfilling it with additional growth. So Integra being a great example. Integra was always drilling, and you saw that in George's presentation. And by the time that Integra had a cutoff date for their resource estimate, and they were delivering that resource estimate to the market, they already had enough drills. Sorry, this is the COVID environment. The kids run in at night. So they already had a bunch of drill results already delivered to the market. And as a result of that, the resource estimate, by the time it hit the market, was effectively almost out of date. And it really kept investors focused on their stock. It really kept a lot of sizzle in the story. And they were able to opportunistically finance. It wasn't the market was waiting for this catalyst, and then when that catalyst came, the company was quickly there to finance. So I think that's a pretty interesting way to think about it, and a strategy around development. And then the other side, of course, is as you're I think de-risking your project, if you get into a situation where maybe the resource estimate has a lot of potential for growth, but maybe the budget or the market isn't there, then you can start thinking about things like joint venturing. And so we've seen joint ventures, not quite as much recently, or you do the strategic interest that George talked about. They've really stepped in light of the market not being there for junior resource companies in the last few years. We've really seen a proliferation of that. But on the joint venture side, you can do that as well. But I think it's really key to think about making sure that those interests are aligned, because you can have pitfalls if you're joint venturing with a very large diversified miner. They'll be looking for a certain type of project. That project may or may not be what you have in mind, or something that's within your capability. So it's something to really think about. I know Jen, you've talked about, or you know a lot about this kind of stuff. So maybe jump in here on the joint venture side.
Yeah, thanks for that. There is actually quite a bit of traction for the sort of junior, senior, or mid-tier joint venturing, and there's a lot of synergies that you can get from that because, to a mid to senior level issuer, it's attractive to be able to, look at a junior that has a potentially, interesting property, possibly in a jurisdiction where the senior doesn't actually have operations, doesn't really have a lot of experience, but thinks that there's a commodity, a resource there in that project that's enticing them. So often you'll see situations where the senior and the junior will agree that in exchange for the junior sort of bringing this property to the table and quite often bringing their own experience in that jurisdiction, the senior will come in and actually finance the development of that project to a certain stage, whereby then the senior will actually earn an interest in the property. Quite often you can sort of end up in a situation where the junior can, end up not only getting cash payments, which can help float your working capital, but you'll also get the expenditures covered. So the company, the senior company will actually help fund putting money into the ground. In addition to that, the junior may end up being the one that operates the project and operates the work programs, given that they would likely have experience in the jurisdiction, although not always the case. These are highly negotiated agreements. But the junior can actually also collect an operator fee, which again helps with their balance sheet. So not only are they're getting the expenditures funded by the senior, but they're also, getting some cash in exchange for running the programs. Obviously, that all comes at a cost because the cost is that the company is going to give up a stake in the project if ultimately the senior ends up, passing all the gates in order to earn the interest. Usually there's some sort of preset expenditure or a combination of cash payments. There also can be an option of actually having an economic study be one of the deliverables for sort of getting and crystallizing that final interest in the project. So the senior in that case, for instance, may be required to spend a certain amount of money and deliver a bankable feasibility study, which can help sort of catapult that project and that property for the junior into the realm of actually being able to make a production decision. Again, comes at a cost in the sense that the junior is going to be relinquishing some and possibly a majority control of the project. You're more likely in that context to see the senior actually taking more than a 50% role, so that once they've earned an interest, the joint venture will be ultimately controlled by the senior. And you can compare that to a situation of a sort of joint venture of equals, where you have a 50-50 joint venture, which we've seen in the case of, Barrick and Corp, now Newmont, where they had actually 50-50 joint ventures, more akin to what George alluded to with the whole merger of equals. This would be a joint venture of equals, essentially. So there are a lot of different things to think about. They're very highly negotiated deals, but they can be an option if, say, equity is not on the table and you're not quite at the stage of the M&A. There is an option then to do this joint venture and option agreement, which can end up being a good situation, and in any event ends up with an advancement of the project. And if ultimately the senior ends up earning an interest in it, there is potential to actually move forward with the project.
Hey, Jen and Kevin, on that theme, actually, there's a question that I think is, and George addressed it a bit, but Mark Bristow came out recently and said that the days of the premium deal are done, and that deals moving forward will be exactly what he said, sort of the mergers of equals. Do you think that that's the case? Do you think that that's going to change in the cycle?
I can go first. I think the answer is no. I don't think that's the case. I think it's amazing to see the M&A cycle has kind of been a cycle in and of itself, in addition to the commodity cycle. I remember, looking at back in the previous cycle, when you come out of a period of really tough equity markets for commodities, you typically see the large marquee mergers. It's a flight for relevance. It's a flight for scale. And really, with the Barrick Randgold, the Newmont Goldcorp merger, those are really flights to be relevant. You've got companies like Google and Apple that have $1 trillion market caps, and our entire gold sector at the time probably was capitalized at under $200 or $300 million. So that fight to get generalist money into the sector was really, I think, a key consideration around becoming a large gold mining company. But what we haven't seen in the sector yet in this cycle is the acquisitions where the producer buys the developer. And so those typically do carry a premium, a control premium, because the merger of equals are categorized by, bringing the best of management teams together. But on the typical junior acquisition of a senior or an intermediate buying a project, there's usually a control premium. I think that will come back. There's a multiple arbitrage there.
Interesting. And
That actually is a really good segue then into sort of moving us forward in our deal cycle. So now we've talked sort of about the options while you're trying to finance exploration, finance ultimately coming up with an economic model to prove whether there is actually something in the ground that's economical to take out. So now we're going to move into sort of more of the development stage. And that's actually where you do see this sort of impetus for M&A activity to come about. So maybe I'll just toss it over to Kevin for a second. He already touched on, but if you can just talk about sort of what you're seeing in the M&A world, and then we can turn it back over to me, and I can talk about some of the things to consider when a company is trying to get itself into the position to be ready for M&A.
Sure. And Josh, before I start, does that answer the question, or is there a follow on there?
There is, but we're also running out of time. So
okay.
We have a few other questions if you guys want to kind of quickly wrap up, and then I'll just sort of toss you a bunch because there's quite a few lining up here.
Sure. I think in terms of the development, I think that the takeaway is there's been a proliferation of what I would call alternative sources of financing. So again, it's just something to have in your toolkit. This last cycle is categorized by the rise. There's a lot more royalty companies available now that are willing to finance development stage companies. There's been a very large growth in the amount of PE activity in our sector. And what I think what's interesting about these groups is that they're playing across the balance sheet. They will put equity and they will play on the debt side and do convertible structures in addition to doing their royalty or their stream or whatnot. And so they're an interesting tool. We've even seen private equity groups take a development stage asset private. So there's been actually a take private transaction in the last couple of years. So they're very interesting groups. I think they're very technically savvy. And I think the biggest key takeaway is they've got very patient capital. These LPs are typically 8 to 10 year time horizons, so they can make investment decisions that are maybe different than some of the traditional fund managers on the street that, like I said, get mark to market on their portfolio and they have to deal with redemptions, a lot of other challenges. So there's new actors in the space, and I think that's probably my big takeaway. So Jen, do you have anything to add?
Not on that specific point, but I thought maybe it would be worth now just kind of quickly touching on then this whole M&A landscape and sort of if Junior is going to be in a situation where it may end up entertaining an M&A deal or whether it actually can be the acquirer in an M&A deal. There's obviously a lot of things to think about as far as structuring goes. Quite often you'll find that they're structured as a plan of arrangement where they're court approved and shareholder approval is also obtained. That's sort of the less attractive structuring aspect of it, but something that's really interesting and things, people often negotiate quite heavily on are deal protection mechanisms that are going to be put in place in order to, ensure that the target and the acquirer end up actually being able to solidify this deal and actually close it. So you've probably heard a lot of things about no shop, no talk, which basically, buttons up, zippers all of your employees, executives, any of their representatives, so that there is no ability to sort of go out and facilitate another deal. This is these are restrictions on the target, but depending on if it is sort of more of a merger of equals, there will be a reciprocal no shop clause. There's also clauses put in place that if a target ends up getting an acquisition proposal, it ends up being a superior proposal, that the acquirer gets a chance to actually match it. And if they don't want to match it, they can actually be entitled to a break fee, which I think Kevin has a pretty good example on how that was actually a very effective deal protection mechanism quite recently, if you want to talk about that.
Yeah, sure. It's I think everyone probably has seen the Silvercorp Guyana Goldfields transaction. So it's an interesting one, and just from the perspective of how a break fee can kind of service the buyer. So here's an example where the buyer showed some discipline. They had a friendly agreement with Guyana, included the break fee. Sure enough, other buyers surfaced in the public markets, and what ended up happening is after a couple back and forths, Silver Corp now has announced that they're going to allow it to slip and let the company be sold to another bidder. But interestingly, between their break fee and the fact that they acquired some of the stock ahead of or in conjunction with the transaction, I think the number is something to the tune of $30 million for Silver Corp to walk away. So while you don't get the first prize, which is the asset, walking away with $30 million and having proven that you were seeking good value, someone was willing to pay more, and you showed the discipline to walk away, and you get sort of a $30 million check for your efforts. I think it's an interesting transaction.
Yeah, thanks. A couple other sort of deal protections. There's something called a force the vote, where you can actually require the board of the target to put the deal to a vote for the shareholders, even if there's what could be a superior proposal in the wing. So it basically just forces the shareholders to actually have the say in whether they really think that your deal is the best deal. There's some unique deal protection mechanisms that aren't super common, but they're, everyone's always coming up with new things. One in particular is something called an asset lockup, where a bidder can actually get certain rights over the target's assets, whether that's through joint venturing, licensing, options, etc., that can actually be exercised and triggered if the target rejects the deal in favor of a superior proposal. So again, not very common, but it's a creative, interesting way that deal protection can kind of be woven into a plan of arrangement. Of course, there's support agreements, other things that you can ensure that you have a big shareholder base locked up. That's another way that you can protect yourself. Of course, that's dependent on what the shareholder base is like, whether there are some significant shareholders that you can tap into and gain their support for the deal. This is obviously all structured as a sort of a negotiated M&A deal. Obviously, that can differ from sort of a takeover bid concept, where it's a hostile bid and the company actually ends up basically just being the target, unwanted, but they're the target of a takeover. So that's just something to differentiate here, that the plan of arrangement context is obviously negotiated, friendly in the sense that it's a reciprocal transaction, but not so friendly that it's not heavily negotiated.
Interesting. So for the sake of time, can I pivot you guys to some questions? Because there's actually two that are sort of perfect for the banker and perfect for the lawyer. So Kevin, we'll start with you quickly. What do you see as the most important evaluation analysis when it comes to looking at a project? EBITDA, NPV, IRR, PNAV. When you sit down and look at something and maybe pitch a transaction to another company, what's the strongest analysis? What's the strongest way to get it over the table?
It's a good question. I think as a banker, it comes down to accretion. So it's all of that, but it's accretion. So it's what is the ability to pay ultimately, and whether we're acting for the buyer or we're acting for the seller, you're trying to maximize that for your client. So if you have a particular client that, let's say, has a very strong balance sheet and can afford to build larger projects, then obviously CapEx is not as important of a consideration, which means by nature, IRRs are typically smaller if you've got very large CapEx projects. So what you really are looking for is what's the fit. If you have a very competent underground miner that knows this part of the world and your project happens to be there and it has sort of the grade profile and the mine design attributes that they're good at, you would look into the acquirer's multiple and say, well, what does the market ascribe to them for doing that and doing that well? And ultimately, if you're acting for the seller, you're going to try and chin them up and pay up to that multiple. So really, I don't know if attributes matter as much. I think generally in this market, we're still, despite the fact that gold is running so well, we're still not seeing the mega projects being green lighted. And so I think in terms of if you were just showing a buyer a suite of projects that were potentially available, you would want things that have modest CapEx, manageable CapEx, and reasonably quick permitting and construction timelines. The one thing that we haven't seen yet, and I don't think we'll see it soon, is some of the seniors or intermediates taking on projects that have unknown or very long permitting timelines.
Interesting. And Jen, the one for you, which is a really interesting question, is do junior companies need to be listed to move forward, or can you advance as a private company with joint ventures or private private placements, not via shares?
That's a very good question. Yes, you definitely can. Interestingly, actually, there's been some appetite for structuring sort of joint ventures between two privates with the idea of, doing equity financings of those private companies on a private placement basis. And maybe in the future, looking long term, having an idea of going public, but it not being, as Kevin mentioned, a lot of mining companies go public early on because that is the way that you can try and attract investment. But, depending on what the network is of the people behind the two companies, or any one company within the mineral project, you can definitely still, attract investment from a senior if you have the right pipeline, you have the right network. Definitely instances where, I've worked for senior listed mining companies that end up joint venturing with a private company that, it's a sort of one or two property company that's very closely held. And the major will come in and do a joint venture. And often a lot of seniors that I've dealt with have actually find that attractive in any event because there is such a tight level of control. You know exactly who you're dealing with when you go in there. There's not a lot of changeover as far as management and the board goes. So when you enter into a deal, especially if you're going to have the junior operating, you know exactly who is going to operate. You can do your due diligence on the one or two people that are actually leading the charge on the company, and not be worried about, a shareholder base shifting those people out and replacing the board, replacing management. So no, it's a very good question, but yes, you can definitely see it on both sides. There's benefits to both.
Interesting. So I've got two more questions, but we'll do it as a speed round. So quick answers. Everyone gets a chance to answer. I think coming out of the last cycle, you heard a lot about companies paying huge premiums for assets that were in riskier jurisdictions or not necessarily, fully vetted. Do you think that the major mining companies learned from their past sins, or do you think that if this heats up again, we'll see a real flurry of M&A with some questionable assets being acquired? Bit of a loaded question too for you all, but figure why not. And George, why don't we start with you, but you're muted. Yeah. And then we'll go around the circle to George, Kevin, then Jen.
Say that major mining companies or the acquirers have learned their lessons and from the sins of the past, mistakes of the past. I'm going to say no. It's going to happen again. Yeah, that's it.
Okay, Kevin.
My answer is yes. They're gonna do it again. They're gonna do it again. But I think political risk is you have to look at who the buyer is. My example I'd throw out there is the best multiples in the gold space for years was Randgold and Agnico. And you couldn't have two different political risk profiles depending on where you sat in the world. North American investors obviously viewed Africa as risky, and I'm sure people in Europe and the like didn't view it as risky. So I think there will be deals. There's a dearth of good assets in the world. At some point, the political risk tolerance will get to a level where they'll go after some of these really great assets around the world.
And Jen?
I'm inclined to agree. No, I agree with everything, and in the interest of speed.
All right, so the last question, we'll wrap it up and we'll go the other way around the horn. So starting with Jen, then Kevin and George. What would be your number one advice for someone looking to push through an M&A transaction in this market?
Ooh, that's an interesting question. And, I have to lawyer it and say, well, this is not advice. This is just information.
Right, sorry. Put you on the spot there.
I think that things that George touched on, and I think things that Kevin and I have talked about, really is the best thing is to be prepared. One, and I think Kevin has talked about this before, but don't be too desperate. The desperation deals are not obviously going to be very attractive, but at the same time, being prepared, having your data room up to date, being in a situation where you have all your ducks in a row, so that if somebody does want to come and propose something to you, you're actually going to be in a position where you can entertain that deal in a timely manner and not have them lose interest and move on to something else. So I think being ready but not desperate is probably a good idea.
That's great advice. And Kevin?
I would say the best way to get an M&A deal done is don't have to do an M&A deal. So to George's point, your best competitive tension is threatening just to do it on your own. So have alternatives. And I know that's easier said than done, and every situation is a little bit different. But if you can create competitive tension either through potentially another bidder or on your own from being able to advance it yourself, that is where you'll find you'll probably be more desirable and for most suitors. So.
Great. And then George.
Face your M&A suitor in the eye and say, "Don't make me build this. Don't make me build this." Seriously, that's just a funny way of saying, you know, all of the above. Just take the project as far as you can yourself. Always have the option of not just selling it, but advancing the project forward and or building it.
Perfect. All right. Well, thank you all for joining, and appreciate Jen, Kevin, and George for your insight. This was the first try here at the webinar and the Toolkit series, so thanks for breaking the ice. And for those that are still hanging around, make sure you tune in next week on Thursday, where there'll be the next round of the Toolkit, which is Stephen DeJong, who was the former president CEO of Integra Gold and now the president of Verify, and he'll be talking about perfecting the pitch. So really how you need to be able to pitch your project in the elevator up to your formal meeting, and then how you need to then step into a 45-minute presentation with, you know, a whole group of people. And then I'll actually be talking about millennial mania, which is how do we attract the next generation of investors and employees into the mining sector. So thank you so much for joining, and we'll see you next week.
Thanks very much.
Thanks, YMP.
Kevin, thanks, Jen.